Welcome to QuickBooks at Kapiolani Community College. In this video, we'll go over Chapter 6, which deals with the sales and collections cycle for a merchandising business. If you compare a merchandising business with a service business, they differ substantially because they stock merchandise inventory. Their business cycle is longer and has more steps. Most things merchandising businesses sell are those that they keep in stock until they're sold. Now, merchandise inventory is an asset and appears on the balance sheet for the company. When you're recording a sales in a perpetual inventory system, the cost of merchandise inventory, or inventory asset as QuickBooks calls it, goes from the inventory account into the cost of goods sold account. So it moves from the balance sheet to the income statement when it does that. You'll see cost of goods sold subtracted from net sales on the income statement to yield gross profits. And in this sense, the cost of the merchandise is well matched with the revenue that's generated through that merchandise. You'll see it pop up on a multiple step income statement such as this one. First we have sales or net sales, and then we subtract cost of goods sold to give us gross profit. After that, operating expenses like rent and so forth are subtracted to give us income from operations or operating income. Then other revenues and gains and other expenses and losses finally get us down to net income. Other revenue sources for a merchandising business like services might not involve merchandise inventory. In that case, the revenue and its costs may not be well matched, and they might even be recorded in different accounting period unless we do special manual procedures. QuickBooks Online and QuickBooks Desktop differ because QuickBooks Online uses a FIFO cost flow assumption or inventory method. Both of them, of course, use a perpetual inventory system. In a perpetual inventory system, when you sell an item of merchandise, the merchandise inventory is automatically reduced and the cost of the oldest inventory item on hand goes to cost of goods sold. This is the FIFO cost flow assumption. So what's left in your ending inventory is the newest items or the most recent. So those costs make up your ending inventory, like in this example shown here. We can make sales for cash or on account. When we sell merchandise inventory, there have to be a minimum of 4 accounts in the journal entry. So every time a sale takes place in QuickBooks, whether it's a sales receipt or a sales invoice, at least 4 accounts will be impacted in the journal entry. If you count sales tax, if sales taxes are charged, then there will be 5 accounts recorded in the QuickBooks Online sales tax function. So a sales receipt is a sale for cash. A sale of merchandise for cash then involves a debit to undeposited funds, a debit to cost of goods sold for our cost, credit to sales and merchandise inventory for selling price and costs respectively, and if there's sales tax, then sales tax payable liability accounts gets credited. A sale on account is identical except that the debit is to accounts receivable instead of undeposited funds. Integration in QuickBooks happens between products and services and our sales and general ledger accounts. These different QuickBooks Online components have to communicate with each other automatically. Now, products and services will connect sales and all the inventory related functions. They have to know what items they're going to send to cost of goods sold and what general ledger accounts to post transaction amounts to. If you have a larger accounting information system, accountants refer to or call the various areas of the system modules, and all of them working together is what's called integration. Now, how the transactions from the different modules are connected to general ledger accounts might have to be specified in something called a general ledger interface table. So QuickBooks is trying to avoid technical terminology, and so they call their names friendly sounding things, but essentially they're doing the same thing that the larger, more complex system is doing. They're just doing it and calling it different names. So let's take a look at products and services inside QuickBooks. Products and services you get from the gear over here. You can see several items here. Accessory services, inventory items. If we take a look at this item here, brown sugar clay foot mask, let's look at that. You can see it's an inventory asset. It has a category, by the way, which you're allowed to do. And the income account that's linked to is sales of product income. This body wash or something like that. They're supposed to have a spa. And purchasing information, you can put a memo under here if you want, but it doesn't have much connection to the vendor. And the quote-unquote expense account is cost of goods sold. So you can see how there's a link between the inventory item as well as its related general ledger accounts. So you can have from one to several general ledger accounts. A sales tax item, for example, if we sell several different products or services, they could all be hitting different revenue accounts and different theoretically different cost of goods sold accounts. Well, that's a little bit more complex. If we sell a bundle, which is a collection of multiple inventory items, that same applies to that. When you set up products or services, there are several different item types. The sale of merchandise inventory usually will be inventory asset, the income account, sales account, and the cost of goods sold account connection. And inventory is usually just one single item by itself. A bundle is a collection of several different items and kind of grouping them. And some items that you sell don't do any matching of costs, so they have no inventory account connected with them. That would be non-inventory and services. Those items, if there are costs related, you're going to have to do it through some other system rather than inventory system. One important thing here, if you're playing around with your different item types or product and service types and you change a service to an inventory item, you can never change it back to services. So I would be cautioning you against doing that carelessly. Also, you might want to take a look at this article that I have linked here, as it goes into pretty great detail about products and services and their connection and capability for editing and changing and so forth. So there are some problem areas in products and services and purchases, sales for merchandising companies. Your product and services list can get kind of messy because you can add products or services kind of whenever you feel like it. So you might have something that you have listed already and you just didn't find it alphabetically, and then you start having sales made of two different products instead of one product. So if you have things that you want to list several of them together, you might want to look at bundling them or counting them as a bundle. Discounts will only be applied to immediately preceding lines. So what you need to do on your invoice is subtotal it and then have the discount immediately following that. If you need another discount again later, that discount will only pick up whatever was included since the last time you subtotaled. So you need to plan out the order of items you're going to list on your invoice. Now, discount items that are on the invoice are not really the same as sales discounts or cash discounts or what we call early payment discounts, but QuickBooks treats them like that. When you record a discount when you've received the payment, that's called a sales discount or a cash discount. It's a contra revenue account, and you'll see it on the income statement under net sales right here, sales discounts. However, in QuickBooks, it doesn't occur when it's supposed to occur. Usually it's picked up when you collect the cash, but in QuickBooks you have to go back, modify the invoice to show the discount, and make sure the discount pops up before the sales tax, otherwise you'll get the wrong amount of tax, and then go ahead and receive exactly the amount of cash that's listed on the bottom line of the invoice. So the accounting impact on that is that the only reason why that journal entry is going to work is because you've actually reduced the invoice total already. The accountant's already reduced the invoice total. It's not a very good procedure, and it's lots of extra steps. So if we do a sales discount, the impact of that is this: to reduce revenue by a debit and to reduce accounts receivable by a credit. And when we do the actual collection, normally you would have the undeposited funds along with the sales discount on the same side. However, because we've adjusted the invoice already, there is no sales discount showing in our journal entry. So expect either one of these on an exam, for example. When we do credits, give credits or refunds or NSF checks from our customers, those are three special situations. A credit memo is when we generate a document for the customer that tells them that they're able to reduce the amount they owe us. And the best way to do that is to have a sales, returns, and allowance account, but QuickBooks does not use that. In recording a credit memo, we debit sales and also put the merchandise back in merchandise inventory, debit out the sales tax payable from the sales tax payable account, credit accounts receivable to reduce that, and credit our cost of goods sold to reduce that. Now, this credit will eventually have to be applied to the related accounts receivable in order for that accounts receivable to clear in the proper amount when you collect the actual remaining cash from the customer. If we do a refund for the customer, we also have this option of clicking a Use Credit to Give Refund button and generate a check for that customer. A very special situation requires careful handling in QuickBooks is when we receive a non-sufficient funds or NSF customer check. The situation with an NSF customer check is we have booked it as a cash receipt and a reduction of AR. The bank has put it into our account, credited our balance. It goes to the check maker's account, and then they reject it. So it comes back to our account and at the bank, and our bank takes it back out of our account and then sends the check back to us. So essentially whatever receivable we collected, we didn't really collect it, but there's a dirty trail of transactions that we need to capture. So since the deposit that had the bad check has already been made, you have to go back in to the deposit window, undeposit it, edit the bad check collection, and unapply that from the original invoice. And then you have to create a bad check item charge as an invoice and take that original payment and apply it to the bad check item charge. What that does is that frees up your original invoice to look as though it has never been paid, and then the aging and everything connected with that will still follow through and it'll show as being very overdue. So when you have a bad check, you're still going to have to chase down your customer to get your money. So here's essentially what happens. It takes the money back out of your checking account and increases your accounts receivable from that customer. And we're going to pass through charges, so that means we have that reversal of the deposit and reapplication to the bad check item, invoice item, and we're also going to want to charge that customer for an NSF fee. Differing accounts, NSF checks, bad check charge, fees billed. The QuickBooks changes its mind periodically about which charge should be used for NSF customer check. A special situation that we have in Hawaii is the existence of our general excise tax. Very few states use a general excise tax, but Hawaii does. It's not a sales tax. In a sales tax situation, the vendor is required to collect from the customer the tax amount and then forward that to the government. In a general excise tax situation, we're not required to collect it. We can go ahead and pay for the tax ourselves, but many businesses go ahead and collect it anyway. So what does this mean? The sales tax in the mainland or other states is computed based on the amount of sale of the product or service. In Hawaii, it's based on the total amount collected, and it's not a sales tax, it's a general excise tax. So what that means is if you have a 4.5% tax, you're going to have to pay 4.5% of the 4.5% that you collect. And then when you collect that, if you collect that, you're going to have to pay 4.5% of that too. So there's this kind of never-ending 4.5% on whatever you collected. The normal approach that most accountants use, or many businesses use, is that they charge the customer 4.71%, and in that way they pretty much collect all of the tax on the tax. So for example, a invoice of $100 times 4.5% would give you $4.50. Add that to the $100 and you get $104.50 collected from the customer. But wait, you have to compute the tax on the $104.50, not the 100. So your tax will actually be $4.70. But wait, if you collect that, then you have to compute the tax on that. So you see the way it goes. It eventually sort of tops out at about 4.71%. So for most accountants in Hawaii, they fix this by creating a revenue item in QuickBooks called General Excise Tax, and they use that as like an item or a sales item, kind of like a service on invoices and sales receipts, instead of using the sales tax function. So a journal entry in that kind of situation would be a debit to undeposited fund, a debit to cost of goods sold, credit to sales, and then a credit to the sales tax account called General Excise Tax. And it'd be a revenue type account, and credit to merchandise inventory. Then when the sales tax is calculated, it would be based on sales and the General Excise Tax, like the combined total. So to get this to work, you have to subtotal your invoice just before you do the General Excise Tax, and then charge it at whatever rate you want to charge it. And when you prepare the General Excise Tax returns and calculate your General Excise taxable income, you have to use all of your revenue type accounts. And then at the end of the period, adjusting journal entry, debit an account called General Excise Tax Expense, and credit an account called General Excise Tax Payable for your calculated amount of total General Excise Tax. If you see it on the income statement, the service item in sales and the General Excise Tax Expense should net out to just about zero. One last item here, almost. Sales estimates can be made in QuickBooks, and you have to keep in mind that it's just an estimate. It's not really a sale. So when you create an invoice from the estimate, you'll turn it from a pending sale into an actual sale. Otherwise, nothing will get recorded in your AR. So to enable that, you have to go to Account and Settings, Advanced, Automation, and then see that Copy Estimates to Invoices is clicked on. And you can also click on the setting category Automation, and you'll see a more detailed view. You want to change the drop-down box Copy Accepted Estimates only to Copy Pending and Accepted Estimates, and then you can convert any estimate into an invoice with or without officially making it using the QuickBooks status. And then under Customers Estimates, you can make your estimate and copy to an invoice. You just click the estimate in the estimate window and click the Start Invoice button. And once you've done that new invoice view, you can click on the estimate invoice, and you want to add to the invoice in the invoice panel. So estimate statuses are pending. The customer is still deciding whether they want to accept your estimate or not. Accepted, you still have to do the work. Closed, the customer has been invoiced. And rejected, the customer doesn't want it. So unfortunately, QuickBooks currently will not convert estimates into sales receipts. So if you have an estimate that the customer is going to pay you for immediately upon receiving the service or the product, you're going to have to manually re-enter that as a new sales receipt, and then go ahead and mark your estimate as accepted or delete it. Deletion is not really recommended. Typically you want to keep a trail of your dealings with each customer so that if you have to go back and research it, you can find it there. Thanks for listening. Hope this helps.